Hello everyone and welcome back to the Modern Investing channel. What about if I told you that there is a company that is the Google search engine of China, but also the Netflix of China, the Google Maps, the Wikipedia, the Reddit, but also the number one in number of patents on artificial intelligence. Among the top 4 cloud solution providers, a leader in autonomous driving and much more. How much would this company be worth? We are going to find it out today, and the company I'm talking about is Baidu. We will start with a fundamental analysis of the business, and then we will run a discounted cash flow valuation to get the fair value of Baidu stock. If you get value out of this video, please leave it a like and subscribe to the channel for more content on great undervalued stocks. It really helps the channel if you do so. Thank you. Baidu is together with Alibaba and Tencent a Chinese tech giant. It runs a lot of businesses ranging from search and information, lifestyle and traveling, knowledge and learning, social communication, tools and application, leisure and entertainment, and much more. Its backbone is the online marketing and advertisement space, which made approximately two-thirds of the revenue of the company in the full year 2020. Baidu controls the search engine with the vast majority of users in China, more than 70% of the market share, which make it resemble Google in the Western world. And just like Google, this segment attracts a ton of advertisement revenue. But there are a lot of more apps generating ad revenue. Apps for video sharing, travel review, experiences, Baidu Wiki, etc. Cloud is a strong growing industry all over the world, including China, and approximately 9% of Baidu revenues come from there. And finally, IQE, the Netflix of China, of which Baidu is a majority shareholder, generated 20% of the revenues in 2020. This revenue pie here is a strong base that Baidu is sitting on. The marketing advertisement business and IQE are quite stable, where the marketing sector actually contracted 5% in 2020 as compared to a year earlier, where the lockdowns played a negative effect, and IQE saw a small growth. The outlier here, however, is the cloud business, with an impressive 44% growth year over year. If this remains the case, cloud will of course become a much more important part of the company revenue split in the future. Overall, we are looking at a tech giant with a strong core business, which by itself makes it a strong player. But on top of that, there are a lot of other things. Baidu is a spawner company, spitting out many high-risk, high-reward initiatives. For example, Apollo, which is a driverless vehicle developed by Baidu and a consortium of more than 40 companies. It uses Baidu artificial intelligence technology to drive the autonomous car to a level 4 autonomy. A big milestone was that Apollo received the permit to operate autonomous driving at night and under special weather conditions on public roads in Beijing. In Shanzhou, Apollo Go begins to charge for robotaxi rides based on the distance traveled, starting with a minimum fare, similarly to regular taxis. Very exciting. A recent news is that Baidu reached an agreement for the purchase of YY Live for $3.6 billion, which is a video-based entertainment live streaming business in China with more than 40 million monthly active users. There has been some controversy about this. Some people were excited, others say that there is some fraudulent activity around YY Live. We cannot know whether this is the case. We will have to wait and see how this plays out. Furthermore, there is Druer OS, which is a virtual voice assistant that leverages Baidu artificial intelligence platform to handle voice recognition and implement actions based on that. Also, Baidu raised $2 billion capital from other investors to start developing their own chips. This move was made to handle in an efficient and economical manner the cloud business, as well as the voice recognition devices and self-driving. It is possible that this chip business may become in the future to serve other customers than Baidu itself and become a part of the revenue pie. These that I mentioned were only some of the small initiatives of Baidu. Really a lot of growth vectors going on. I think this is very exciting because what is the worst case scenario? Even if these bets go to zero, Baidu has all the huge advertisement, cloud businesses, streaming, etc. to bring the company forward. But if one of these bets make it, and for example, Baidu establish a robotaxi network in China, it is going to be huge. I really like this because by investing in Baidu, we can potentially be exposed to these hyper-growth initiatives without making a risk investment because the core sectors of Baidu are going to do well regardless. The way I look at Baidu is that they are sitting upon the artificial intelligence technology platform. That's what they are leaders on. And this technology is what is feeding their biggest part of the business, which is the targeted advertising on their search engine, video apps, and all apps in their ecosystem. Plus, they leverage on the artificial intelligence capabilities for their high growth initiatives, voice recognition devices, and driverless cars, among others. So, how much is Baidu worth? Before we answer that question, let's look at the metrics of the company in US dollars. First of all, revenue, which is how much money came in, also called the top line. It has increased over the years, although it then kind of stagnated from 2015, where it took 5 years from 2015 to 2020 to increase by 60%. The number of shares outstanding have been decreasing a bit, thanks to buybacks of the company. This delivers value to shareholders because it increases the shareholder ownership within the company. The company is not paying any dividends at the moment and is reinvesting the remaining income in growth. If we look at the book value, which is a measure of the company total assets minus liabilities, we can see that it steadily increased year over year, indicating that the company is becoming more valuable each and every year, and that the proportion of assets increased as compared to its liabilities. Next, let's look at three metrics that describe the profitability of the company: operating profits, net income, and free cash flow. Operating profit is a metric that deducts the cost of goods sold and operating expenses from the revenue. Cost of goods sold include all the costs and expenses directly related to the production of goods, whereas operating expenses include the cost of operating the business, the sales, R&D, HR, etc. We can see that there have been many ups and downs over the years, with big dip in 2019 as well as a dip in 2015 and 16. Overall, it is an increased trend trajectory, which is good, although we can see that it topped in 2017 and remained quite flat thereafter. This metric tells us that the business has been good at scaling up until 2017, but thereafter it struggled to convert the increase in revenue to profit due to a faster increase in expenses. Net income is the bottom line of the company. It is calculated by taking the revenues and deducting operating expenses, cost of selling goods, taxes, interest on debt, and amortization and depreciation, which is the loss of value of equipment and building and other things over time. Net income increased over the years, up 3x from the 1 billion in 2011 to the 3.4 billion in 2020. Very volatile, however. It peaked in 2015 and it did not show a clear trend increase ever since. Another important performance metric is free cash flow, which is the cash that the company made after conducting its business. I will take a minute now to explain the difference between net income and free cash flow because although both represent how much the company makes, they are based on very different metrics. Free cash flow differs from net income in the way that free cash flow only represented the actual cash that the business has generated in a given year after paying for all expenses, whereas net income also takes into account other accounting incomes and expenses that have not influenced the cash movements in the business in the given year. For example, net income also includes revenues from items that have been sold but the payment have not been realized yet and that will come in the future, whereas free cash flow does not because the cash hasn't come in yet. Also, net income takes into account amortization and depreciation, which is the loss of value of, for example, equipment and buildings over time due to aging. Free cash flow does not because depreciation is not an actual loss of cash, it is an accounting exercise. Free cash flow, though, does take into account capital expenditure, which is, for example, the purchase of a new building or equipment, etc., because the company has lost that cash to buy that equipment and building. Net income would not account for that, and that expense would actually go in the depreciation scheme instead. For these reasons, it is important to look at both net income and free cash flow to have a good idea of the company performance. Free cash flow grew steadily and nicely until 2017, but then it actually decreased over the next years. These tell us that from 2017 the company struggled gathering extra cash from its operation, despite the increase in revenue we have seen. Overall, these numbers tell us that the company has been growing in terms of increasing sales and gathering more revenues, as well as the book value of the company increased, which is the net assets the company has. However, as the company became larger, it struggled converting the extra revenue in free cash for the company. There can be several reasons for that. One is certainly that the company expanded its property, plant and equipment segment, which grew fast from 2018. This has benefited the book value that in fact increased steadily, but it hurted free cash flow. Another reason must be R&D expenses, which increased over the years and became a bigger part of the expenses split. R&D expenses were about 10% of revenues in 2011 and 12, and they grew to about 18% of revenues in 2020. This means that the management is very committed into the long term and to keep the company relevant, which is good. But of course, it has a negative impact in the short term on earnings and free cash flow. An interesting thing I spotted is that the days payable, which reflect how many days the company take to pay its suppliers. As you can see in 2017 and 18, it stretched that period enormously to more than 100 days, whereas a long-term average is of 10-20 days. This delayed payment inflated its 2017 and 18 numbers, but backfired in 2019. Luckily, now that we can see it at a normal level again. I don't know why they did that in 2017 and 18, but I don't like to see this because it looks like financial engineering to me. Let's now run a discounted cash flow valuation to determine the fair value of the business. What this calculation do is that it will discount the future cash generation of the business to a required rate of return, so that we can calculate how much to pay for the stock in order to achieve a desired return. My required rate of return is 15%, which is very high as compared to most investors, but that's how I roll. So we put that value in this field. I assumed a conservative 5% yearly growth in cash flow in the next 10 years, and I assume that in 2030 the company will be valued at the same multiple as today, 17. The sum of the next 10 years discounted cash flows plus the terminal value of the company discounted at a 15% rate gives us the intrinsic value of the business of 43 billion US dollars. If we correct that for the cash they have and for the debt they have, we reach a 47 billion and 844 million dollars valuation of the business, which divided by the share outstanding gives us a fair price of the stock of $142.82 per share. If we look at Baidu's current price, it trades at $166 per share, meaning that Baidu is overvalued by about $25 per share. We are close, however, to the fair value for a 15% return on investment. And remember that this calculation only takes into account the business segment that are generating cash now. All other artificial intelligence initiatives that might generate cash in the future are not counted in this fair value calculation. So that is just a bonus that comes with Baidu. Lately, Chinese stocks have been hit hard by a number of reasons. US-China tensions, big hedge funds margin calls, and the fear of increasing regulatory scrutiny by the Chinese government. In my opinion, these fears are over-exaggerated. They don't really interfere with the fundamentals of the business, so they shouldn't distract investors. I think the current dip in Chinese stocks represent a good buy opportunity more than anything else. However, it is China, and it is a factor that you must be able to stomach. As I mentioned earlier, there are rumors of YY Live having fraudulent activities that could be a risk factor for Baidu. In conclusion, I like the stock and I will add it to my portfolio. I love the fact that it is a dominant business with a massive moat that will likely do well in the future. It has realistically too many sources of revenues and growth to fail. And on top of that, you get basically for free all the artificial intelligence bets initiative that are spawning from it. My conservative intrinsic value calculation puts it at $142.82, which is about $25 below the current stock price. Let's see if panicking investors will sell me the stock for 143 in the near future. That's it for today. I hope you learned something new, and if you enjoyed, please click the like and subscribe to the channel. It helps with the YouTube algorithm and allows me to make more videos like this. And let me know in the comment section what you think about this investment. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my view and is meant for entertainment only. Please do your own due diligence before investing in any instrument. Have a great day.